Ladies and gentlemen, please welcome to the stage, Michael Saylor.
I'm streaming it.
Oh, yeah. I'll be watching it back here.
Yeah, exactly. Backstage.
To the stage, please welcome to the stage, Michael Saylor. Michael, thanks for being here.
Thank you. Nice to see all the orange ties and the orange hats and the orange tennis shoes and the orange shirts and the orange lanyards and the orange dresses. I definitely envy the women that can wear the bright orange dresses and the orange jumpsuits. I've been trying to figure out how to do an all-orange suit that'll work for me. I'm still working on it, but get ready. So I'd like to talk about Bitcoin Treasury companies, and I wanted to lay out, the basic principles. There's a lot of ignorant antagonists in the world, and they're like all snivelly, like, why would you want to buy a Bitcoin Treasury company when you could buy the Bitcoin? And you hear that a lot. I mean, we're the first year, in my opinion, this is the first year in the launch of this business. If you got in more than 12 months ago, you were sort of ahead of ground zero. I would say the business really legitimized, took off November 5th, 2024. That's the point when you had the red sweep. That's the point when Bitcoin went from 60,000 to 95,000. Very quickly, what we saw was 12 cabinet members flipped pro-Bitcoin. The president flipped pro-Bitcoin. The Secretary of Treasury flipped pro-Bitcoin. And guidance from the SEC, the CFTC, the OCC, the FDIC, even the Federal Reserve and the Treasury, all flipped to unequivocally pro-Bitcoin. If you look at crypto policies with the mega banks, the too big to fail banks, Bank of America, Citigroup, Wells Fargo, et cetera, they were constructed over the previous 4 years. And in that environment, after the execution of Signature Bank and Silvergate, both of those were healthy banks that were destroyed by the previous administration due to their involvement in crypto. I think most large systemically important banks, most banks in general, adopted a policy out of an abundance of caution, and the result of those policies was so vague, it kind of meant that everyone in the industry was unbanked, you couldn't get credit, and those policies still remain, by the way. You could post $10 billion of collateral to those banks, you can't get a nickel loan today. Okay, so that's not because of government guidance. The government guidance is exactly the opposite over and over and over again. But the banking system of the Western world is uncramping itself, and it'll probably take 4 years for that to happen. And during that time frame, we're just in this epic of institutional adoption. You've got the right accounting, you've got the right guidance, you've got the right law, you've got the right tone at the top. And that just means large, risk-averse, bureaucratic organizations are going to take their time to work through it. But it's not like every single week I don't have a conversation with the president or the CEO of a bank or some other large financial organization where I point out that they're about to miss out on trillions of dollars of opportunities. And this is why the private bank, the commercial bank, the investment bank should get involved. If you have I couldn't have those conversations 4 years ago. Now we're going to have those conversations every day for the next 4 years. We're going to convince 10%, 20%. And so we're in this transition. I think there's two massive forces in the world today. There's digital intelligence, there's digital assets. And if you look at financial institutions around the world, what's amusing to me is you've got financial institutions that embrace digital intelligence, like my company, I sit down on a Saturday afternoon, I play with the AI, I design a security, I redesign the security, I design the security for the third time. The AI says it's never been done in the history of the world. I send it to the lawyers. They say it's never been done in the history of the world. I send it to the bankers. They say it's never been done in the history of the world. And then they come up with one little quibbling concern like, oh, there might be a fast pay issue and it's unsolvable. And then after 2-3 weeks of tradition, I go back to my AI and I say, is there a solution to the fast pay issue? And it says, yeah, make the liquidation preference floating. Okay, where's the floating liquidation preference come from in our prefs? It's because there's a fast pay issue in the prefs and you can't sell them above par without that floating liquidation preference. I could hire 10,000 lawyers and wait 10,000 years. I wouldn't get the answer. I got the answer in a few minutes from the AI because the AI has no prejudice. It has no inertia. Okay, that's a finance company that uses digital intelligence. What happens next is we print $6 billion of those. What happens without AI? We sell zero. Everyone says, well, what's the killer use case of AI? Well, maybe design a security and sell billions of dollars a month of it. That might, how many people do that? One. I'm sitting at a table with a lawyer that works for a mega multi-trillion-dollar financial organization. I said, you know, do you use AI? No, our legal department won't let us use AI for security concerns. They don't want us to put confidential information into the AI. Okay. You literally have a set of megacorps that won't use digital intelligence for security concerns, and they basically make everybody that works for the company slow and stupid. And then you have another set of companies that use AI, and those people are smart and fast. Now, if you take digital assets, it's the same thing. Those, you know, a different set of banks, you know, they're like, well, we don't touch digital assets, you know, because the government, because something happened 4 years ago. Well, they're, you know, what I would say is poor and weak. And if you embrace digital assets, you become wealthy and powerful. And so, by the way, I can show you finance organizations that embrace digital assets, reject AI. I can show you ones that claim they use AI, but they really reject it. They just tell themselves they use it, and maybe they do or do not embrace digital. But, you know, I think the opportunity for Bitcoin Treasury companies, what are they? You know, they're digital companies using digital capital, hopefully using digital intelligence to create digital securities, digital equities, digital credit instruments to sell into the digital economy. Nothing that we've done would have worked without digital capital. Bitcoin is digital capital. And most of our more compelling ideas came from digital intelligence because no one ever did that before. You know, like when we designed our prefs, we set them as par value 100, made them perpetual. No one ever does that. You can find 5,000 examples in the modern world where people don't do it. They normally make retail prefs $25 or they make institutional prefs $1,000. Okay, it turns out if you go back and read the history of the Rothschilds and the history of money, the British government in the 1780s did it. The British government issued consols. They were perpetual bonds, par value 100 pounds, yielding 3 or 5% that floated above or below par. And I look, you know, backed by gold. We created something, 100 par value, perpetual, backed by digital gold. Okay, and so what happened in the middle? For 100 years, the world went backwards, and now we rederive these elegant instruments that, by the way, every French, Austrian, British, Spanish, Italian central banker, they used the same instruments 300 years ago. In fact, the entire world ran on gold-backed credit for 300 years or more. That was the currency system of the world until 1971, with varying degrees of collateralization. So we're in year one of reinventing the finance system, issuing digital securities and digital credit on digital capital, and we can do it into digital channels. And Right now, there are digital channels like the NASDAQ or other standard securities markets, but in time, there'll be the crypto ecosystem, 24/7, 365, tokenized, self-custodied. You know, your securities will be self-custodied, your credit instruments will be self-custodied. They'll all trade everywhere in the world at the speed of light. Now, let me talk a little bit about, Treasury theory. Bitcoin Treasury Company, what's revolutionary? Well, Bitcoin, digital gold. We all acknowledge digital gold. Okay, digital gold, digital capital, better than gold, right? Capital, economic wealth that lasts forever. You buy 1/21 millionth of all the money in the world forever, right? That's the idea of digital capital. You know, that's a powerful idea. Pure economic energy. Outperforms the cost of capital because it's pure economic energy. When's the last time the human race agreed on something that was pure economic energy? Well, it was gold for 5,000 years. And now we're starting to re-agree. 5% of the world is starting to re-agree that we've got a new form of capital. Instead of metallic capital, which is what gold was, we've now got digital capital. If you've got a digital capital asset that outperforms the S&P, right, you can capitalize a public company on it. That means you become positively polarized to capital. That means that the more securities you sell, the more shareholder value you create, the more capital you can raise. And for the last 100 years, the entire world was capitalized on sovereign debt or fiat credit instruments. They underperform, therefore they're negatively polarized to capital. So there's a profound idea here, a paradigm shift. If people don't get it, right? They're a strategic incompetence, right? A lot of people don't want to get it. If you're just a cynical, curmudgeon-y, short seller, short-sighted trader, you don't want to understand. You just want to hate on it, so you're not going to. But once you embrace the idea that Bitcoin is digital capital, then the next issue is, well, what is Treasury Company? Well, Treasury Company is just a new kind of corporation, literally impossible in the world where public companies are capitalized on fiat credit. It doesn't make sense to sell equity to buy back sovereign debt because the equity cost of capital is above 14%. The sovereign debt has an after-tax yield of 3%, 2%, 1%. Doesn't make any sense. Doesn't make sense to issue corporate credit to buy back fiat or sovereign debt either, right? Makes no sense. What does make sense? Well, issue securities backed by digital capital. I'd like to say we understood this business 5 years ago. We didn't, right? Our entree into Bitcoin was first defensive, then it was opportunistic, then it was strategic, and finally it became transformational. Then we realized we're a different company. So what is the basic premise of a treasury company? Well, it's very simple. You have a block of digital capital, raw digital energy. Here, it's commodity. The world doesn't want it. What the world wants is a set of securities, either credit instruments or equity instruments or derivatives that meet their requirements. The analogy I've used before is Standard Oil. Think of a refinery. I have a block of raw liquid energy. Einstein said matter and energy, they're interchangeable. I have raw liquid energy in the form of a barrel of crude oil. The first application was kerosene. Kerosene is jet fuel. Kerosene lights up your house. Kerosene was light. Kerosene is rocket fuel. You can't light up your house with a barrel of crude oil. You can't fly a jet with a barrel of crude oil. So we needed kerosene. We refine it. We mark it up. But there's gasoline, there's diesel, there's asphalt. And then if you actually go on an AI and say, tell me all the specialty chemicals of crude oil. There's also lycra. There's also acrylic. There's also plexiglass. There's PVC piping. Your lubricants, every form of plastic, stuff you eat, nylon, polyester, right? It goes on and on. We build the houses, we turn the machines, we look through these things, and they're all products, right? So I can refine it to be a different form of energy, whether it's kerosene or gasoline or diesel, or I can create lycra, or I can create plexiglass, right? And so products, services, forms of energy come from that barrel of crude oil. How big is that? Well, I mean, just think about, at some point, Standard Oil also owned half the gas stations. So you've got gas stations, you've got every type of energy, and then you've got DuPont, and you've got everything that every chemical company ever created. And look at the stuff you're wearing, probably. You're wearing stuff that came out of a barrel of crude oil, right? It's the stuff that's in your tennis shoes, right? So it's not a difficult stretch to say, oh yeah, in the first year when John D. Rockefeller, maybe 1865, when he started screwing around with a barrel of crude oil and out came some kerosene, a lot of haters said, well, there's no future to this industry, right? And of course, the industry today is, what, a third of everything. Now let's take that digital energy. What is the role of Bitcoin? You know, we say Bitcoin miners, they recycle stranded electricity or stranded energy. Well, Bitcoin Treasury companies recycle stranded capital. Okay, more than half the capital, 2/3 of the capital is locked up in structured institutions right now. It's capital sitting in a bank, in a pension fund, an insurance fund, and a retirement account, and an institutional investment fund, and an index fund. In a money market fund, right? They're all locked up, the great majority of this capital, and they're in certain places. So what do they want? Well, you know, the insurance companies and the pension funds, they want long duration yield, right? That's what they want. The money markets, they want this very short duration liquidity credit spread. Everybody wants something different. The equity investors want leverage on some underlying business model. The derivative investors want that. Now, if you think about, think about the process of creating a piece of digital credit. What I think in my mind is, this is a block of plexiglass, or this is a block of acrylic. Just think like a big block of plastic that's a meter by a meter by a meter. And then I have a CAD/CAM system and a computer-generated machining, or a machine that's computer controlled, so I can operate the lathe and I can chip out anything I want from that block of plastic. So I put in whatever my image is, I unleash the computerized machine, and I get out some beautiful sculpture, right? Not quite 3D printing, but something like that. I'm converting a block of raw material into something, a beautiful work of art. And of course, what does the person want to see? How many different types of sculptures? There's infinite types of sculptures, and they're all just coming from a single block of some kind of acrylic or plastic. Now, I think about digital capital. It's like you have a bunch of digital capital. You have $1 billion of Bitcoin on your balance sheet. You can carve out any digital credit instrument you want, right? And credit instruments are varied. What's the degree of collateralization? Is it 10x over collateralized? What's the degree of liquidity? What's the credit guarantee? Can I get my money back in a year, in a decade, in a century? Is it perpetual? What kind of yield does it give me? What's the yield curve? Is it high duration yield? Here's the magic trick, right? You're a Japanese company, you want to create 5% yen, 5% yield in yen forever. How do I create that, right? Is there a market for that? Yes, there's like trillions of dollars of money markets in yen that get 50 basis points. So if I can carve out 500 basis points and I create this currency, I'm going to take the currency risk of the yen, I'm going to create this yield, I'm going to actually create duration forever. And what's the collateralization? Do you want 10 over collateralized, or 5 or 2? What kind of credit risk is going to be embedded in this instrument? I can actually sell you that instrument, and I can collateralize it 27-to-1. I can collateralize it 20-to-7-1 and give you a credit put, every 3 years, and I can completely change the nature of the credit. Or I can collateralize it 2-for-1. I can create sub-junk yield, right? And I can give you a different instrument. So when it comes to credit, you've got all sorts of investors. The Russians don't want US credit. The Chinese don't want US credit. The Japanese don't want US credit. The Canadians, the Europeans, they don't want to take credit, they don't take currency risk. So you can create a credit instrument, if you're a Bitcoin Treasury company, in any currency, with any degree of duration, with any degree of collateralization, with any degree of volatility. I talked to a guy probably richer than everybody in this room, and he's got a bit of Bitcoin, and someone says, well, why do you only have like 1-2% of your portfolio in Bitcoin? He says, well, frankly, I'm like something years old, and I can't handle the vol. Okay? 75-year-old, 80-year-old guy with a lot of money, he just doesn't want a 50 vol, 50 ARR instrument that you have to hold for, if you call it indefinite duration, in theory it's 120 months. So if you're willing to hold this thing for 10 years, somewhere between 120 and 240 months, I'm pretty confident you get yourself like 30% a year ARR. But when you're 92 years old, who wants to actually hold something for the next 25 years? They don't want it. And so there are a lot of people, there are very wealthy pockets, and they can't stand the duration. They can't handle the volatility. Another example of people can't take the vol, corporate treasurer. You know, you've got a Bitcoin company, you believe in Bitcoin, but you got to make payroll, and you need to make your rent, and so you have working capital. You know, conventional wisdom is keep 1 year of working capital into the currency that your liabilities are denominated in. That's your treasury. You're not going to put that in Bitcoin. You're going to put that in, right now you're going to put it in a money market, and in the US it'll give you about 3% after tax. But in Japan, it's going to give you 25 basis points after tax. In Switzerland, it's going to give you minus 50 basis points. The entire yield curve in Switzerland is negative out to 4 years. In Europe, it's going to be 200 basis points, maybe. So you've got how much? 30, 40, 50 trillion dollars tied up in treasury instruments and money markets and the like between Japan, Europe, Switzerland, Canada, the US. 30 trillion in the US alone. They can't stand the vol. They want you to strip the vol. They want you to strip the interest or the yield duration off the instrument. Just give them pure spread. So what is the closest thing to kerosene that we can produce in this industry? It's basically pure yield. Something like we created with Stretch, it's like if you can just strip away the current, you know, I live in Japan and I like the 400 basis point treasury, but I can't stand the US dollar risk. I can't stand the currency risk. Strip away the currency risk, strip away the duration risk, strip away the volatility, strip away the credit risk, give me liquidity, right? Serve it up to me in some sort of credit instrument. And, you know, take Metaplanet, they're sitting on billions of dollars of Bitcoin. If they can open up the credit side of that trade and they can sell Meta yield at 5 or 6% in JPY, they'll be arbitraging 50% US dollar ARR versus 5% in the yen, and they capture the 45% spread, right? Which is, to say they're getting 90% of the economic gain is an understatement. They're getting 100% of the economic gain up front. They're getting 90% in the first increment, compounding exponentially. So when you set up that instrument, you're getting like 95% of the economics, right? And so when you think about what is the opportunity here, everywhere in the world you need treasury companies. Why? Because you're creating the high quality credit. And what credit? Well, you can you can create that pure yield product and you can sell it direct retail, go to the retail like sort of we're doing. You could also create that product and partner with the largest bank in Switzerland and you could power their treasury. You know, well, B of A is running treasury for $1 trillion or something, so what if you actually power the treasury of another bank and you become a B2B player? So a company could pursue a strategy where they create the yield and they create the return or the credit instrument, but they sell it through a bank. Well, how many banks are there? 25,000 banks. There's 25,000 people to sell it to. Well, what else? Insurance companies and annuity companies. There's companies that have hundreds of billions of dollars and they're on the hook for annuities. Open up a pipe to the annuity company or the pension fund and you just sell the yield directly through. You could do that as well. Also the insurance business, right? And so when I look at this, people go, well, you know, how much room is there for Bitcoin Treasury companies? That's like, you know, some dude says, why would you want to buy a hamburger on the Upper East Side for 40 bucks when I'll sell you a hamburger for $3 in Kansas? Well, because I don't live in Kansas. That's not, okay, well, so I guess there's room for one restaurant in New York. Well, what about the people downtown? What about the people who live in Tokyo that want to eat, right? The truth is there's a lot of room for restaurants. There's a lot of room for, how many banks? 5,000 banks in the US. There are 25,000 banks in the US 80 years ago or 100 years ago. So 100 years after they're obsolete, there's still 5,000 of them, right? There will be thousands and thousands of treasury companies. Just like there's thousands of insurance companies, thousands of funds, thousands of banks. And why will they exist? They will exist because the risk-free fiat credit rate is 50 basis points in Japan and minus 50 basis points in Switzerland and 200 basis points in Europe and 400 basis points in the US, going to 300 basis points soon. And the world wants 10%. Right? And who wants 10%? Everybody. Okay, so the real issue is, how are you going to wrap it? How are you going to construct it? I want it to run on my rails. You know, you can buy Stretch on NASDAQ brokers, but you can't buy Stretch on Robinhood. Okay? How do you get the security to go down the rail? It's kind of like, yeah, I got a hamburger, it's $3, but how do I buy it in London when the hamburger is getting served up in San Francisco? The distribution matters, the container matters, the compliance matters. The marketing matters, right? I mean, do they like you? Do they trust you? So, you know, when I think about Bitcoin Treasury companies, I'm like, well, do you have the management team? Do you have a strategy? There's 1,000 strategies, 1,000 ways to do this. Do you have a focus? Do you have a, do you have a capital market, right? Orange BTC is coming public in Brazil. They'll be the first company that's where the capital structure has been designed to be elastic to support ATMs and the like in that capital market. So constructing the company with the strategy in the right capital market is important, but it goes without saying there's going to be a monster treasury company in every capital market. It won't be us in Japan, it'll be Metaplanet, most likely, right? There'll be a monster in every capital market, but that doesn't mean there isn't room for 100 other very successful companies in every major capital market. You ask the question, how much capital is there? How much financial repression is there? Right? And I'm not going to go and issue credit instruments in Turkey because the rate's like 46% or something. I'm not going to go there first. I'm going to go and issue credit instruments, where a 10% seems like a screaming home run, and 10% against a 30% ARR over 20 years, it works out to about 90% of the economics go to the issuer. And then it just comes down to a question of how you're going to construct the credit. And there's stupid credit, and there's difficult credit. And I guess I'd say there's a simple rule of thumb here. If some guy with $1 billion is sitting across the table at you, offering to give you the money, it's probably in their interest, not yours. If I wanted to sell $1 billion note that had the warrants of equity, that had the credit protections of a bond, and do it with a single counterparty, I would have 25 companies staying up all night to do that deal, and it would be done tomorrow morning or the next day. It would be awful for my equity investors. It would be bad for my capital structure, but there's a certain amount of money that'll come to you that's easy to get, that's just not necessarily good for you. And then there's the money that you have to work at. Like, I'm going to build a retail channel to 10 million retail customers and sell them a preferred instrument without the credit risk, which has got huge amplification for the equity. That's harder. It's hard to do the things that they're going to create massive shareholder value for your company. It's easy to get big and do things that basically transfer your equity and your credit collateral to a investor. So I would just say the business is going to explode. There's going to be 1,000 ways to win. We're in year one. Don't listen to the critics and the whiners. Think about the critics of the petroleum industry in 1866 and put yourself in the place of the entrepreneurs and ask yourself, would you get dejected when the price of crude oil traded down 35% and people told you it's a crap business? Because that's exactly what happened to Rockefeller, and what distinguished him is he just always believed that it was going to work, and when everybody else was selling, he was buying, and when they were buying, he was buying, and when everybody was whining, he was building, and when everybody said, in 1909 or whatever, when the entire industry was mature, right? That's when the automobile got invented, and it got 10 times bigger. So this thing is going to be big. There's no reason that credit, digital credit, the credit on gold became bigger than the gold supply. The digital credit may be bigger than the Bitcoin network. If Bitcoin goes to 100 trillion or 200 trillion, there could be 200 trillion of credit on top of it. You may not want to issue it. That's up to you. Someone will want to buy it. And that is the future that the market will determine. And the market is 100 industries, 100 capital markets, and your job as a Bitcoin Treasury company, solve the problem, solve the compliance problem, solve the tax problem, solve the issuance problem, solve the credit problem, do the marketing, do the product design, solve the distribution problem, evangelize the future of digital capital and digital credit, and roll with the punches, right? Don't get liquidated on volatility. Build the most robust structure you can. But otherwise, we are all, if the Bitcoin miners are the first line of electric defense or computational defense of the Bitcoin network, Bitcoin Treasury companies are the first line of economic defense. They're the ones that are going to spread the entire ideology of digital capital, of perfect money. The guys that say, fix the money, fix the world, that's all well and good. But the truth of the matter is, you didn't have to envisage that everything else disappears except perfect money. It's not going to happen. So a better thing to be thinking is, if I'm going to fix the money and fix the world, I need to fix the equity, fix the funds, fix the banks, fix the money markets. I need to fix the credit instruments. I need to fix the currencies. I need to fix the policies, fix the politics, fix the ideologies, fix the attitudes, fix the distribution, fix the technology. That's not happening just via tweeting. That's going to be a company in Japan, in Switzerland, in the UK, in the US, in Nigeria, in Brazil. They're the ones that are going to fix all that stuff. And as you create all of these digital, wonderful, beautiful instruments of the 21st century, you're going to win fans and supporters and believers in the political system, in the media, in the economic system, in traditional banking, in traditional finance. They will be brought over to the orange movement, and then they'll start to believe in Bitcoin. But at the end of the day, just don't fall into the trap of thinking that all the world needs is Bitcoin. It doesn't just need Bitcoin. It needs equities and credit, and it needs currencies, and it needs governments, and it needs companies, and it needs funds, and it needs services, and it needs products. And it's companies that are going to create these, and it's hopefully the people in this room today. So thank you for coming, and thank you for being part of this movement. And I look forward to hearing each and every one of your stories.